In this session, let us understand about capital gains with respect to slump sale. This is provided in section 50B. First of all, what is slump sale? Let's take an example. Let's say there are two companies. One is a seller company and the other one is a buyer company. Here the seller company is selling its whole or part of the undertaking as a going concern to buyer company on as is where is basis, that too for a lump sum consideration. Then we call it as slump sale. Okay. Here either the whole or part of the undertaking is sold. It is sold as a going concern and the consideration is in lump sum. It means no values are assigned for individual assets and liabilities. Okay, and when slump sale is made, it is possible that there will be capital gains or losses. In this session, our focus is on long-term capital gain or short-term capital gain that are arising from slump sale. At first, we have to arrive at the capital gain, then we should decide whether it is long-term or short-term. So first, let's focus on capital gain computation. Take the full value of consideration, reduce it by deemed cost of acquisition and cost of improvement. So what you get is capital gain or loss. Now comes the question, what is this deemed cost of acquisition and cost of improvement? This is nothing but the net worth of the undertaking or the division which is getting sold. Okay, right? So what is net worth? Net worth, what is considered here is the deemed cost of acquisition. It is the net worth which is considered as deemed cost of acquisition and cost of improvement. So how to compute this net worth? It is simple. Take aggregate value of the assets or undertaking, assets of the undertaking, reduce it by the value of the liabilities of that division as per books of account. So you get net worth. And if there are any changes in value of assets on account of revaluation of assets, those changes will not be considered in this net worth calculation. Okay. This aggregate value of total assets figure will vary according to the nature of the asset. If assets are depreciable in nature, then WDV of the block of assets have to be considered. If assets are already depreciated 100%, then no value should be considered. Or let's say if whole expenditure has already been allowed under section 35 AD, then again no value should be considered. For all other assets, only book value should be considered. Okay. Having derived the capital gain, we have to decide whether it is long term or short term. If the undertaking sold has been held for more than 36 months, then that profits or gains from that slump sale will be chargeable to income tax as capital gains arising from transfer of long-term capital assets. It will be deemed as income of the previous year in which year the transfer took place. Okay, if that undertaking has been held for a period less than 36 months, okay, or only up to 36 months, it will be chargeable as profits or gains from transfer of short-term capital assets. And the point to be noted here is no indexation benefit will be available when assets are sold under slump sale model. There is also an additional compliance requirement for slump sale, that is at the time of filing of return of income, assessee should also furnish a report of a chartered accountant, and this report should be in a prescribed form and it should show the computation of net worth of the undertaking or the division, and then it should have a certificate that net worth of the undertaking or the division has been correctly arrived as per provisions of this section, that is 50B.